Good afternoon, everybody, and thanks for joining us this afternoon. My name is Jonathan Sheehan, Managing Partner of Compass Private Wealth. I'm joined by Peter Smith, who will appear shortly from Aviva Investors. And we're delighted to welcome you here today to discuss financial planning and wealth management for business owners and the self-employed. So just to kick off with a bit of housekeeping. So there is a Q&A button on Zoom, so please feel free to put questions to us throughout the webinar, and we'll endeavour to answer them during the webinar or at the end. We will send a recording out afterwards, so if you missed anything, you'll be able to watch it back. We'll also make the slides available. There's a lot of slides, a lot of content, so hopefully if you don't capture it all in the call today, you can watch it back and read the slides afterwards. The first thing is I'll speak about just general wealth management principles for business owners. Peter will then give a macroeconomic overview. I'll then speak about financial protection and the 13 key risks that business owners face from a financial point of view. Peter will come back in then and discuss global investment markets at a high level. I'll then take the learnings from Peter's discussion about investment markets and discuss investing and portfolio management, either through company funds, pension funds, or for personal funds. We'll then discuss cash flow planning, which is extremely important in the current market environment with high inflation. We'll then speak about retirement planning, and eventually we'll have a Q&A at the end. But as I said, please do jump in with questions as we go. I will endeavour to answer them as we go throughout the webinar. So the first thing to talk about is the 8 pillars of holistic wealth management. So there's 8 distinct yet interrelated factors that one should always consider when looking at their personal finances. The first is retirement planning. So unless you plan to work until your late 80s or 90s, there's always going to be a level of retirement. And we generally find as clients get to above 50, 55, retirement planning always becomes more relevant and more of a focus for them. For all of the assets you have, the financial assets, the intellectual capital assets you have, your business assets, whatever it is, it's always important to make sure that the allocation of those assets is appropriate. So asset allocation is very important, and I will speak about this in the context of protection and risks and what our advice is in terms of markets as well. With anything you do in business and your personal finances, tax and cost efficiency is very important because they are 2 drags onto your ultimate performance. The more tax and the more unnecessary fees that you pay. Managing your risks is very important. Obviously, as a business owner, the risks are a lot different to somebody who's a PAYE employee. And generally, the younger you are, or maybe if you've got younger children, the more there is at stake. So the higher the risks are as such. Generally, as a business owner, you have to be a lot more mindful of risks than if you were in the public sector or in a normal PAYE job. Educating yourself financially is very important because the more successful your business is, the more profits, the more capital, the more there is at stake, and therefore the more important it is to be financially literate and to be up to speed on your own financial affairs so that you can make the most appropriate decisions with your capital. Investment selection. So a lot of what I'll speak about today is the high level markets, high level asset allocation. But then when a decision is made on how to allocate capital, it needs to be done quite intentionally, and the selection of the investments is very important. Cash flow planning, we'll have a full chapter on that today in this webinar. Cash flow planning is very, very important, as I said earlier, in the context of high inflation and more volatility. Ensuring that your cash flow is positive is very important. And finally, succession planning, which is for business owners very relevant as the capital value of your business increases, hopefully in line with increased profits over the years. How that is passed on to the next generation or to other individuals within the business is very important from a succession planning point of view. And the red lines here are just here to demonstrate how everything here is interrelated. So what's the difference between a business owner and all else and everybody else? There's more risk to your livelihood. There's no doubt about it. There's a lot less protections for you. As a business owner, you're out there in the cold face and there's more at stake. It's as simple as that. From a financial point of view, there's definitely more uncertainty. Your income levels are more unpredictable than if you were on a fixed income every year, and your outgoings are also more uncertain. You need to make more proactive capital allocation decisions within your business. So most people don't take all of the profits from the company out every year. It makes sense to take a certain amount out as salary, for example. There may be one or more shareholder. You need to have discussions about that. There's decisions about a holding company, about pensions, about taking salary or bonus, or just leaving within the operational business as well. So you have to consider the capital allocation all the time. There are the 4 different places where ultimately when we meet our clients, you try to say, look, if there's surplus capital above and beyond what you need to take out as gross income on an annual basis, these are the 4 options. And how do you make that decision? People who don't have their own business don't have to face that decision because their income is what they get ultimately. You also need to be proactive on tax planning. As any of our clients on the call know, we don't give tax advice. We'd always suggest you deal with your own tax advisor or accountant in that regard. But you do have to make decisions on tax on an ongoing basis. Again, the PAYE system in Ireland is top class. Somebody, is loaded into the ROS system or into the revenue system. The tax credits, standard rate cut off, and your net salary is always going to be correct, and there's no choice around that. Whereas when you run your own business, you need to be a lot more creative and thoughtful in terms of how your tax is considered, both from a corporation or business point of view and personally. Succession planning, you want to make sure that all your hard work is monetized or capitalized somehow, either during the life of your business or at the very end. When you work in your own business, there's less protection benefits. So a lot of people who join a big firm, they may not even know this, but a lot of the time they get defaulted into a company pension scheme. They get defaulted into what they call group death in service, which means that if someone's salary is 100,000, by default, they'd have a 400,000, 4 times salary life cover through the employment. And also there may be income protection. So a lot of those benefits, it may be sick pay policy, all these different things, you don't have it as a business owner. So now I'm going to mute myself and turn off my camera and pass over to Peter Smith to speak about the economic update.
Thanks so much, Jonathan. So I'm just going to basically give an overview of how we see things at the moment from an economic perspective. Initially, I should introduce myself. I'm Peter Smith, and I'm an investment director for Aviva Investors, kind of focused on the Irish market and the investments we have in the Irish market. So today, what I wanted to initially, I suppose, think about was this first slide here. And as you can see, I think markets and from an economic perspective, we have an awful lot to think about at the moment. It doesn't take too much to fill a page of the concerns and things that we need to think about, from starting from the top left-hand corner, the US-China relations. There's 2 sides to that. There's trade tensions, but there's also, issues around the sovereignty of Taiwan as well, which keep sort of rumbling on. And as we go across, I suppose we're all very well aware of what's happened in the US from a regional banking point of view. I'll talk about that later and how that's impacted on possibly interest rate rises in the future and the contractionary effect that has on economic demand possibly over the next number of months. High inflation is something that we've been aware of for the last year and a half. It's something that we've been fighting, and it's linked to lots of things on this page. Whether it's global recessions or interest rates, all of these things are interlinked in one way or another. Global recession is an interesting one to talk about because we obviously have had the impact of rising interest rates. The reasons why those interest rates rise is really to subdue growth in some manner or form in order to bring prices back down to a level. The problems, I suppose, both central banks and countries have is whether that landing, and we hear lots about soft and hard landings, whether we are knocked into a severe light recession, depending on how things move, around inflation and interest rates. Tech layoffs, something we saw at the beginning of the year. We saw massive tech layoffs from some of the largest tech companies out there. Kind of the way I think about that is tech companies in general, are managing a business like we run a family. When things get tough, they've obviously cut some of their costs in order to protect their bottom line in many ways. I realize that's obviously very tough for some individuals and employees of those companies, but tech layoffs, there's a reason for that. And certainly this year, actually, consequently, tech companies have, especially mega tech companies like the Amazons and the Apples, have done phenomenally well from a return perspective. Everything that I've kind of spoken about now relates back to that bottom left-hand corner of interest rates. Interest rates are the driving factor behind the issues we've seen with US regional banking. Obviously, they're linked to inflation, recession. These are the interest rates is something that, we're trying to get a handle on. We've never, in decades seen such a quick rise in interest rates over such a short time period. In the US, we've seen 10 consecutive rise in interest rates over the last year. So unprecedented, pretty phenomenal rise in interest rates over that period. And we see that link to the problems that US regional banking has had as a result of that. Those high interest rates have affected some of the money they put on. Basically, they invested in long-term US government bonds, and there was pressure put on their liquidity. They had to sell them at a loss, and that's obviously impacted those US regional banks to some degree. Russia, Ukraine, obviously the war in Europe is something that we continually have to keep an eye on. The big thing at the moment that lots of people are hearing about a US debt ceiling. I'll speak about that in a minute, but certainly that's getting a lot of press coverage at the moment. There's different scenarios that we can look at, and different ways things can work out there. But, moving away from that to real estate, with rising interest rates, there's worries about real estate as well out there, that it's over leveraged, and certainly that's something that's been picked up in the news. The last bit to cover is obviously on the environment. That's something that we're seeing a focus on within our investments, and globally companies are having to address more is their focus on becoming carbon net zero and everything that entails. So moving on to the next slide. And really what all of that points to and what all of that provides us with is pretty poor visibility. When you take into account everything that's happening at the moment, visibility for us to have conviction in how we're aligning portfolios or how we're thinking about the global economy is pretty difficult. Yes, we've had inflation, which has peaked. I think we can say inflation has peaked, and certainly has come down over the last number of months. But it's come down to a level which has become quite sticky. So when we talk about core inflation, that's inflation which isn't headline inflation. It includes, energy and food. Core inflation is more, it's harder to move. It's harder it's harder to bring down to a lower level. When we think about central bank policies, they all have inflation targets of around 2%. Currently, core inflation is around 5 or 6%, and we've moved from that sort of 10 or 11% down to that 5 or 6. But certainly from here on in, we think it'll be more of a difficult journey to bring that down to those central bank targets of around 2%. But certainly going in the right way, and certainly, from an economic perspective, that's a positive. On the interest rate side, I think, like we've peaked from an inflationary point of view, we're possibly at peak or near peak interest rate rises cycle that we've been in for the last 12 months. I think some central banks are ahead of others. You could argue the Federal Reserve in the US is ahead of Europe. Certainly, I think markets, although this moves around a little bit, markets are expecting certainly the next Fed meeting in June possibly to pause rates for the first time in 10 meetings. But even that is, on a week-on-week basis, that sort of the view of markets changes. I think what's changed the view over the last month or 6 weeks is obviously what happened with the regional banks in the US and the impact of that on sort of credit facilities in the US. So in other words, when we think about US banking providing liquidity to the market and credit facilities, they think that will tighten. And the impact of that tightening will lead is kind of the equivalent of a sort of a 25 or a 50 basis point rise in interest rates. So it's kind of juggling those two things. And that certainly made markets think that interest rates may have actually peaked at this stage. I think as we look forward, possibly Europe has further to go, but markets, interestingly enough, are pricing in, interest rate falls in the US by year end, which is quite extraordinary. On the last piece on this page, just around growth, growth I think is surprised on the upside with everything that's going on, all those issues I talked about on the previous page, everything going on, growth has remained pretty resilient, even with interest rate going up to the level that they're at 4 or 5%, growth has continued to be, I suppose, to catch people slightly unaware. I think people are quite surprised how strong growth has been. And in some ways that has, it's this sort of good news is bad news and bad news is good news. The continued worry about growth and the inflationary impact that has means that maybe on the interest rates we've seen more interest rates than we thought we would see at the beginning of this whole cycle. The one thing I would say is we are beginning to see signs of slowing growth in the US, obviously a large market that we consider. We're beginning to see slowing signs, and that's from a job perspective as well as sort of your surveys around manufacturing and service industries. If I can move to the next slide, I've just really graphed where inflation is. I mean, inflation, you can see here, this is on a 2-yearly basis. We go up to 2022 and we can see that, as I said, that unprecedented rise in inflation that we saw following COVID. And inflation, probably peaked at the end of last year, beginning of this year, and we do expect it to fall. I think where our view differs from the market is we still believe that inflation, core inflation, will be more persistent than other market commentators think. It will be harder for us to get down to that sort of 2% level that central banks have set. So that's where our view slightly differs from the consensus. Is we, I suppose, more question what the markets are thinking about. I mentioned interest rate cuts in the US by year end. We have more of a negative feeling towards that. So that inflationary picture, we think, will remain a little bit more persistent and above sort of central bank targets for a little longer than expected. On the following slide, on the other side of things, I'm just showing interest rates, and as I've spoken about these to some extent, interest rates. We can see that very, very steep curve at the end of 2021, going into 2022. They began to raise rates in the US first. I suppose in Europe we're the sort of laggards there, but we can see where we are today. Possibly a little bit more to go, but we see interest rates, and this is where we differ from the markets again. Consensus is sort of, as I said, building interest rates to be cut by the end of the year. I think we'll see them probably plateau and stay the same for a longer period of time. So I think that is something that we will need to get used to. I suppose a regime, an economic environment where interest rates are higher for longer. The last slide in this part of my update I just wanted to focus on was the US debt ceiling. And we're hearing lots about this at the moment in markets. We're hearing lots about it on the news. And when I think about it, I think, there's kind of 3 possible outcomes. And I've given, as much as it's worth, a sort of a percentage of likeliness in each of these scenarios. I mean, the first scenario, which I think is the most likely, is they do a deal in time. So we hear about, Republican, we hear about Biden and McCarthy sitting down in rooms. They sat down last night. Mood music is up and down, but certainly our base case around this is that they will do a deal in time. When we look back over history, since 1917, they brought the debt ceiling into play in the US. It has been raised around 80 times. It has never been lowered. It has been raised about 80 times over that period. And in general, it gets, I suppose the best way of describing it is that the can gets kicked down the road a little further. So what happens if they do a deal in time? 3 points here: limited market reaction. I think the market's kind of pricing for that already. Positive for equities, bond yields fall, so values increase in bond yields. The other side to this is obviously the deal is done late. So when I talk about an X state, what happens with this debt ceiling is basically it's based on how much of their tax takings they get in the next number of weeks in the States, how they're able to pay out and not have to borrow further. So it actually, the date that the kind of markets look at is in June, but it could go on to July depending on the tax take that the US has over the next number of weeks. Obviously, if a deal is done late, it will have a negative impact on equities and bonds. But I think it's kind of a short-lived market reaction to that. No matter what happens, I think they do a deal late. It'll be in July. Possibly they have to close down some functions of the US government as a result. But I think they find a way through. Obviously, the nuclear option is there's no agreement and we get to a deep recession. The impact of that is huge. You have a re-rating of US debt. So in other words, the cost of the US financing its debt increases. Any new bonds they issue, they have to have a higher yield on. And that impact on equities and bonds is far more severe. From my point of view, I think that's certainly the least likely outcome. Jonathan, I'll hand back to you.
Thank you very much, Peter. And that was very informative. And now that we've got you all scared with inflation and debt ceiling and different things, I'm going to make you more scared now by discussing just the financial protection and the importance of it. So what I've done here is I've split out the financial risks that require protection into a few different headings. The first one being your asset allocation and capital risks, okay? And generally, as you know, with a business, every business has a particular sector or a geography or a customer type or whatever it might be. So by default, your business has gone all into one particular demographic or industry or whatever it might be. So that's an obvious risk, which I don't need to tell you, but it's just important to point out. So, you know, the other one then is like too high a percentage of your capital is committed to the business. So some people put all their eggs into the basket and they keep doubling down on their business to the extent that if that business suffers or struggles, they're wiped out financially. So as you can anticipate when I discuss about mitigating risks, there's an obvious mitigation option here, which would be diversification away from your core business, away from your industry and your demographic and all that type of thing. The next one is too much of your personal investment funds or your pensions are invested in any one strategy. So one thing we see quite a bit is business owner, highly successful, running the business, and the allocation of their non-business capital is just thrown into one particular investment firm or one strategy and, oh, sure, it'll be fine. But actually, you're taking a lot of risk with that strategy. So we would always say, when you are allocating your non-business capital, to make sure that's diversified and that's well managed. And I suppose that's what we do. And one thing that we feel is very important is to make sure that you're as diversified as possible. And often, you know, when people think of risk, they think of too much invested, but sometimes too little invested. So people could say, you know, I'm at risk in my business and all my non-business capital, I'm just going to leave it in cash because that's safe. But actually, there is a risk of inflation there. So if you've got too little invested, and if you've got 10, 15, 20, 25 years time horizon for those funds, be it if they're in a pension or not, you know, you will lose the purchasing power of that capital if it's not invested. And that's not to say you should take on disproportionately more risk, but the reality is that over the last 2.5 years, say from, you know, February, March of 2021 up until, say, this summer, the value of cash will have fallen by close to 25%. That's what inflation will have run at over that 2.5-year period. So you have to be careful that in times of high inflation, the value of cash will be eroded over the years. Now, granted, we've had a really, really hot period of inflation that's been quite unprecedented since the 70s over the last couple of years, but still it is important that it's kind of like the Goldilocks, not too hot, not too cold. You want to have enough invested to participate in markets, but also not too much invested so you're not taking too much risk. So that's the first obvious section as capital risk. Then cash flow risk, which is also very important, okay? So obviously, if something happened to you, so your income at the moment as a business owner is based on your business operating. Now, if that income is dependent on you and something happens to you, whereby you get sick or you get ill or whatever it might be, then one would assume your income will drop, and therefore that is a cash flow risk. Another one is that your outgoings increase, and this isn't specific to your business, but it's just generally the cost of living has gone up, the cost of holidays, the cost of energy, the cost of everything has gone up. So really a risk is that the cost of living is greater than your net income, and therefore you're running a cash flow deficit. So cash flow risk is very important. Liquidity risk is something that a business owner might say, yes, but the value of my company is X. But that, if you're 100% shareholder or 50% shareholder, whatever it might be, I'm assuming that shareholding isn't liquid unless you're working as an executive in a PLC where you can sell shares in the market. But if on the assumption that your shares are illiquid and there's not a ready market to buy shares from you, there is a liquidity risk, which is very important. And that risk becomes more onerous the closer you get to retirement and closer you need an exit. Longevity risk is the best of all these risks. This is just the risk, a positive risk. Risk is the wrong word to use here, but if somebody decides to retire in their early 60s and they live until their early 90s, they have to be prepared for 30 years of not earning and having sufficient capital built up to run potentially 30 years of a cash flow deficit. So a lot of us, and we'll talk about retirement planning later on in the presentation, but a lot of people feel as though, oh, they'll retire at 60 or 65. And even if you sell your business or cash out at a decent level, you'd be surprised at how little money that can be if your cash flow outgoings are quite significant. So just be mindful of that. It's a good risk. We want to live long, healthy lives, but it does create cash flow risks. Legacy risk. So if you've got children, grandchildren, whatever it is, a risk is that you die and you can say the value of your company is X, but if you die, the business goes, the value is nothing. So life insurance is very important for that. In non-financial risk is that you're not organized, you don't use a holistic financial planner like Compass Private Wealth, and your assets are everywhere and it's a mess for your surviving spouse, your children, or whoever it is, and that's just a general risk. And one thing with co-ownership businesses, if you've got 2 or 3 or 4 partners or equal shareholders and one dies, there is a risk that the value of that person's shareholding in the context of their surviving spouse or their next of kin or whatever it is, there mightn't be any liquidity to buy that person out, and it creates a bit of a mess. So there are policies you can take out to mitigate that. Other risk, own bias risk. We all have our own biases in life. Everybody's baby is the cutest. That's a great one. Everybody thinks their business is bulletproof. Everybody thinks that their industry, because what happens is when you're in an industry and you're working it, you become passionate about it. And sometimes you need to kind of step back and look at the big picture and say, okay, I am passionate about this. I do run a great business, but I am conscious that I do have a lot of eggs in that basket. And if you don't step back, unfortunately, we've seen the downfall of certain people in this country who just had a view and the emotional bias took over and they doubled down. They kept putting money into sinking ships, and you need to be careful of that. So own bias risk is actually very important. And external risks, which is what Peter discussed there, things like inflation and market performance and all that type of thing. So how do you mitigate these risks? I'll run through these quite quickly. You diversify your asset base. You take a holistic view, look at your business assets in the context of your pension and all of your assets. I like my golf, and somebody gave me this analogy before. A client gave it, and I'm borrowing back their analogy. Stable for golf. So stable for golf over the 18 holes is every time you score in a hole, you rack up your points, and once the points go onto your scorecard, they're in the bank as such. Whereas stroke play is where you can have 17 good holes and you lose it on the 18th. So that's kind of the idea with, say, parking money from the company into a pension. The minute it goes from your company balance sheet into a pension, into an investment strategy that's uncorrelated with your business, you're ticking boxes, you're putting points in the scorecard all the time. But if you say, no, I'm going to reinvest all my surplus profits back into the business and keep doubling up, and if it goes wrong at the 11th hour, you lose everything. So stable for it is very important. Avoid concentrated stock positions. So when you do have funds outside of your business, don't put it all into one particular stock or one particular strategy. When you are investing phase money into the market, for a lot of business owners, you do that naturally by default because you're putting money into a pension on a monthly basis all the time. Compartmentalize capital, so look at some parts of capital for the long term, and therefore you can be more comfortable taking more risk with that. Cash flow risk, you can take out income protection for covering off your income in the event of getting sick or not being able to work. Budget regularly. Personally, I know most people, you're great at budgeting for your business, but maybe not personally. Personal cash flow budgeting is important. Be mindful of debt. Always live within your means. If you're earning good money and you're very confident, then spend as you see fit. But you do need to be mindful of risks and longevity risk and retirement planning. So always live within your means. And if you are helping children financially or plan to help them, just make sure that you put on your own life vest first, that you have enough for your lifetime before you start giving it away, because it's hard to ask it back once you give it away. And build your own private pension. Anybody who knows me knows I'm absolutely passionate about pensions and retirement planning. It's just so important. It's such a no-brainer. If you've got surplus cash within your company, get it into a pension. It's tax deductible for the company. There's no benefit in kind for you, and you can build up to 2.15 million in a pension very tax efficiently. So it's the best possible thing to do in the context of everything we're speaking about today. Having life insurance is very important. Have a will, obviously. If you're over 70 or 75, husbands, wives, they should always have an enduring power of attorney in place. Embrace your assets, discuss it with children, make sure they're aware. If it's a business, make sure other people know about the business. Just carry out as much planning as possible generally with your assets. Own risk, take expert advice, and never put your head in the sand. I'm conscious most people here will finish this and they'll go back to work, and that's what you should be doing. Your most productive capital and your assets, your income is all dependent on you doing what you're good at. So knowing what's going on in the markets is important, but that's more for people like Compass Private Wealth and Aviva investors to be concerned with. We're looking after the allocation of your assets. For you, roll up your sleeves, run your business, and the rest of the stuff you can't control. US debt ceiling, you can't control what Biden says or Trump or Xi Jinping or Putin and all that. So you need to just control what you can control yourself. So now I'm going to hand back to Peter, who'll speak for 7 or 8 minutes on markets.
Thanks, Jonathan. There we go. So yeah, after your comments, Jonathan, I feel I was maybe slightly too pessimistic, because as things stand, when we look at how markets have performed, investment markets this year, they've actually performed really well. So this is where I suppose the economy isn't the markets, and the markets aren't the economy. I mean, we can see here world equities, which is the fourth bar along this graph, world equities, and this is up to close of business on Friday. You can see world equities up by 8.6%, 8.4% year to date. So really strong return in 2023 so far. I realize on the back of a full last year where equity markets took a pretty bad hammering. They were down around 12.5%, 13% last year. But this is just an indication of how, in many ways, markets tend to look through a lot of what's happening in the moment and look forward to the future. So they look past certain issues that we may think are happening at a certain stage in time and look forward. And you can say the same about bonds as well. So we can see here bond returns, fixed income returns year to date have all been positive too. And that's even when interest rates are rising, which should actually decrease the value of bonds. The markets are looking past and have priced in those interest rate rises to some extent, and as a result are looking forward into the future. So you can see here, interestingly, the only real faller this year is the one asset class last year that did extremely well. And this talks to, I mean, it talks to Jonathan's point about diversification. And this is why we build diversification into all the investments that we have out there, is because different asset classes perform in different ways at different times. And it's important to be diversified across that. One really interesting theme this year that hasn't actually got that much attention to any great degree is, if I go to the next slide, you can see, so what I'm showing here, lots of colorful red and greens, but basically this is a visualization of the S&P 500 up to sort of it's the first week in May. And basically the S&P 500 is an index of 500 stocks. The boxes indicate how large those companies are in the index. So the larger the box, the larger the company. So you can see Apple, AAPL on the left-hand side of the screen. You can see there actually the percentage there. If you can read it on your screen, you can see it's up about 35% year to date. So this is the S&P 500. All of these stocks make up the overall return, which up to the first week in September or first week in May was up about 7.7%. What's really, really interesting is if we remove 480 or 492 stocks from that index, the index is still up 6.4%. So 8 companies accounted for 6.4% of that 7.7% rise, which is pretty extraordinary. So you can see the likes of Meta, which is Facebook, up 93. It's actually up about 104% year to date as of close last night. So these 8 companies have actually been driving that market performance. 8 out of 500 companies. It's quite an incredible story. In some ways, it speaks to me about the need for diversification, because the opposite to this can happen at any given point. And we don't want to focus on one market, whether it's the US market. When you're building a portfolio of stocks, you want to focus on having diversification of regions, diversification of types of stocks within your portfolios. These stocks that have done very well since the beginning of the year did very poorly last year. And you could argue some of this is a rebound from last year. Some of it is a whole move in AI as well, but that's another for another day's chat. The last thing here I just wanted to talk about was just our views on equities, fixed income. Equities, we're actually right now, from a very short-term nature, when we are running money and taking positions in our portfolios, we're actually overweight equities. We like what's happening in the US, what's happening in the EU, European equities, sort of less restrictive monetary policy, better than expected growth, company earnings have been better. And that's, as you saw in the last couple of graphs, equity returns have been really positive year to date. Second, fixed income, which took a bit of a hammering again last year. But with interest rates having sort of peaked to some degree, we see now that they offer some sort of balance within a multi-asset portfolio. So we like fixed income. We like fixed income again. We've actually are slightly overweight to fixed income. Cyclical equity, these are things like European energy, basic resources like mining, well positioned for the energy transition, and also that electrification of cars and that kind of thing. So those are 3 key themes that we currently have in the portfolios. What I tend to talk a lot about is short-term views on markets. And Jonathan, you alluded to this as well. On the next slide, what I like to talk about is actually, what markets can provide us over time. And this is the whole point of investing in the long term. This is just a slide that shows the MSCI World Index, over the last 20 years has been up 8% on average per year. Over the last 30 years, it's up 7.5%. And that return of 7.5%, if you invest over 10 years, get a return of 7.5% over that 10-year period, you actually double your money over 10 years if you're investing. So it really has provided, MSCI World, that large global basket of stocks, has provided even over 50 years, a really strong, credible performance for investors, and talks about that long-term nature of investing. Jonathan, if you can just go to the next slide. The other point I just wanted to touch on really briefly was, This is a graph that shows the lighter blues are the falls in markets from peak to trough. The easiest one to look at is the last one on the right from 2020. So that's COVID. Markets fell in March by 34%. What I'm trying to get through here is the following 12 months on that lower graph show the rebound in markets following that low that the equity markets hit. So you can see COVID fell 34%. The following 12 months, you were up 78%. So crucial to stay invested, to weather those storms, to have a long-term plan. And the next slide kind of brings that to light a little bit. Oh, there's a slide just before that one, and we've just skipped. Anyway, so we can move on to this. This next slide talks, I kind of just out of interest, I was thinking what can help people visualize this. And we all buy coffees, take a coffee, $3.50 a day, spend 106 per month on that coffee, adds up to over a 20-year period. If you buy coffee every day, about 25,000 euro loss, if you want to talk about expense to you. What I like to show here is if you actually bought Starbucks stock every day over the same period, $3.50 a day invested in the markets in Starbucks stock over that period, you would have had a gain of 212,000. It's a little bit, taking a little bit of license here. No one's going to invest in one single stock, but even if that was just the overall market, you would have gained over that 20-year period about 79,000 euros. So my point here that I want to leave everybody with is long-term investing in markets, if you're patient, works. And certainly you can see here, it wasn't a big amount outlay that anybody was investing per month, per year, but over the long term, it certainly makes an impact. Jonathan, back to you.
Thank you, Peter. And that was a good example just with the Starbucks, because one of the things I'm very passionate about is pensions. And if you invested on a monthly basis in identical funds in a pension versus in a personal portfolio, the pension will grow about 30% faster, because the pension doesn't have taxes to slow it down. If you invest personally, as you know, in property, you're paying income tax at over 50% on the rent and 33% capital gains tax on the sales. Whereas when that's done within a pension, there is no tax to slow it down as such. So I have a few sections to go through here, and I'm going to do them quite quickly, if that's okay. The first thing here is that there's only 6 places where capital can be parked. There's cash, bonds, shares, property, private equity, which would be your own business, and alternatives. So this is the simplest way of looking at it, that at all times you should know where your capital is parked, and you should have as much of a blend as possible between all 6. Just some key principles we have here is diversification, transparency. So everything you do with your personal finances should be transparent to you, and that really relays back to the communication from the advisor. Always look holistically. Don't ever look at one account in isolation. Look at that in the context of your business, your personal funds, your property, whatever it might be. Inertia is something that hampers a lot of people. So they have these great ideas and then they say, okay, fine, I'll do that again tomorrow. And then they go back to their business and they forget about it. So just be as proactive as possible with your personal finances. Have a clear mandate with all your funds and always avoid conflicts of interest. So rather than going to a stockbroker saying, how should I or should I invest my money? You're better off going to somebody who isn't as impartial, is more impartial, who will give you better advice rather than, yes, invest it and here's invest in our platform. So you always need to make sure that the advisor you deal with has as few conflicts of interest as possible. I'm just going to skip through this slide. This again talks about diversification. We speak about the different types of diversification. There's asset class, geography, investment type, custodian sector, a mix between the liquid and illiquid, and growth or income. So just on the illiquid in particular, your business is illiquid, so therefore you shouldn't be investing in illiquid assets also. So that's very obvious. Why diversify? There's 2 reasons: to reduce your risk and to smooth out returns. Because if you don't diversify and you've up years and down years, up years, down years, unfortunately, if you have a down year and whatever happens with banking issues potentially are the global economy. The down year can unfortunately sink some people. We saw that back in 07, 08, where certain people had good business, but they were potentially over leveraged or too many eggs in one basket, and they just got caught in that momentary period of a couple of years and they were wiped out. So smoothing out returns and reducing risk. Cash flow planning is important. Why? Because you need to firstly calculate all of your outgoings and all your incomes and predict it over the next 1 year and 5 years. It's a pain of an exercise, but it's definitely worth doing. You also need to look at one-off changes to your cash flow situation. So that might be, I need to send my child for 4 years of college, or I'm going to do a revamp in the house, or an extension is going to cost X, or I'm going to put money back into the business to do something else. So this is so important to do. Unfortunately, it's one area of the financial advice that we give to clients where we can't really help them. We have to push it back at them and say, we can give you a lovely template to say, capture your outgoings, capture your income, and work out that all else being equal, will your cash flow position be positive or negative over the next 1 or 5 years? So totting up income is easy. Outgoing is more difficult because it just takes more work. So you're either going to be in a surplus or a deficit position. Outgoings can be categorized as essentials, discretionary, or non-essential discretionary, which is kind of a mix between them. So we know what the essential outgoings are. We know what the discretionary ones are. Sometimes it can be contentious within families to define a particular expense as essential or discretionary. So we put it in the middle, non-essential discretionary. So what's essential for one person may be discretionary for somebody else and vice versa. So it's very important to do that. This will be on the slides. This is just a sample of type of spreadsheets that we help clients with to, we send out a template spreadsheet and we have all these different categories, and the outcome is something like this where you say, this is how my outgoings can be analysed. Here's the mix between essentials and discretionary. We might come back and say, well, you need to cut this or cut that, or we might often come back and say, that's actually fine. We do find when somebody's working hard and they're a business owner, generally their discretionary spending isn't as high as it probably will be, say, when they're retired. So you have to be mindful of that as well, and adjust your forecasted outgoings up potentially for your retirement years. So understand the time period of income and outgoings is also important. So some incomes and outgoings are only for a finite period. So for example, the classic one is generally people are financially supporting children, but once the children get to early 20s, mid 20s, maybe late 20s, whatever it is, they stop being financially dependent, and that can be a big release financially for parents. And there's any number of different, the obvious one is a mortgage. Somebody, from when their mortgage is paid off, that expense is just gone. So you have to be conscious of those as well. Obviously, earned income ceasing in retirement. There's a number of different examples there that will all be in the slides that we send out. So just the last section I'm going to go through, and we'll have a minute or two for questions at the end. It's just retirement planning. So a lot of business owners don't like to think of retirement, but what's going to dictate the value of your retirement fund is the value of today's assets, your years to retirement, the cash flow surplus you're going to have, hopefully, and the return on your assets. The return on your assets can be the value of your business and your non-business assets. So it's a simple formula. If you're 50 and you want to retire when you're 65, 15 years, the value of your current assets is X, factor in what the growth, the cash flow surplus or deficit is going to be, and you get your target value at, say, 65. So this is a simple formula. Again, it'll make more sense when you go through it individually. And what we're saying here is that you get to a capital sum at retirement. And if, don't want to give any specific values because everybody's different, but you have your capital sum. We like then to kind of strip out, okay, what do you want as your safe money? What do you want as something you want to say, help the kids out with property, whatever it is. Always exclude the value of your home as well. Your home is a cost center rather than an asset. It's an asset on death that tax is due on, obviously. but I wouldn't consider it as part of your asset allocation, the value of your home. And then you've got your capital sum for your income once you strip that out. So your outgoings, your regular after-tax income in retirement, you deduct your outgoings, you deduct one-off costs, and you got your cash flow surplus. What I'm trying to do here with these charts is just to show, simplify it as much as possible, to encourage you all to sit down and actually do this exercise. A robust plan must have a capital sum that's greater than the cash flow deficit multiplied by the years of retirement. I'll just run through this section here, and this is a chart I like because up the top here, the first bar, we have what previously people were expected to live until their late 70s, and we retired at 65. So, younger people they'll think of their grandparents, and middle-aged people on this will think of their own parents. Maybe 60 or 65 was old back then, back in the day, but actually that's far from the truth nowadays. The issue is if we want to retire at the same age as our parents or our grandparents did, you have to look at the proportion of time in retirement relative to your working years. And that's a serious financial risk for a lot of people. If you've done really well, you have a big capital, you can retire at 55 potentially, but just be mindful of it. Hopefully you're in good health. We're all in good health. We live well into our 90s. You have to be prepared. If you retire young, you've got a long time of not working and a big cash flow deficit potentially. Cost of living often increases because of helping children or grandchildren out, inflation, healthcare costs, having more time for travel. And unless you've got a significant pension built up, it is a risk. So just be mindful of that in terms of retirement. Ultimately, when you retire, earned income is your employment or your self-employed income. That's going to cease. That's what the definition of retirement is. You just have to replace that with passive income from pensions, from investments, whatever it is, and your own cash savings. And my last slide before we have a couple of questions is there's 3 phases to retirement, okay? There's planning for retirement is the first phase, and that's anybody below the age of, I would say, 55. They all retire at some stage, and it's something the distant, and they start talking to someone like us about making sure that their pension contributions are maximized, that their asset allocation, their pension, their investments are optimized, and you're creating that fund. But when it comes to pull the trigger, there's a 12-month period in and around the retirement that's probably the most important time for everybody financially. A lot of people, the biggest financial decision they'll make in their life is their first mortgage and the first house, the husband, wife, and the house that they grow up in. That's usually the biggest financial decision. Everything else is little career decisions around the edges. But the next big one then is that transition to retirement. And it's a huge decision because you're basically saying, I'm going to stop going to work every day and earning money. I'm going to cease all that, retire, and generate my income for my living expenses and to help out my dependents, whatever it is, by my capital savings and passive income. If you can get your passive income to match your earned income, you're sorted. And that's the most important thing. Then once you're in retirement, we have a lot of clients in retirement. It actually kind of becomes easier because you know what your income is and you know what you've resigned to the fact that you're not going to be working anymore. So it's kind of easier to budget and cash flow, but the difficulty is that transition into retirement phase. And the key principles are maximize your pension contributions, be flexible in retirement age, and have a cash flow plan. So thank you, everybody. We do have a question here. I'm going to, okay, so Peter, you can jump back in here. The question is, where do you see inflation going to in the next, this time next year? So, Peter, I'm not sure, do you have your own view on that?
Yeah, it's an interesting one, and one which speaks to my sort of second slide of It's hard to see visibility on this, but certainly our view is inflation has obviously fallen from its peaks of 10, 11%. We're down at sort of 5 to 6%. Last month in the UK, there was a surprise print that inflation actually rose. But in general, I think we'll continue to see a steady decline, not in line with market consensus, where I think there's more of a feeling that inflation is going to fall quicker than we probably think it will do. So I think we're still talking around the 4% level by the end of the year within Aviva investors, which is slightly behind the curve from a market consensus point of view, but certainly above those central bank targets of 2%.
That's great. Peter, thanks for that. We leave it at that because I promised to get everybody out before 3 o'clock, and we're currently 3 minutes to 3 o'clock. Peter, a special thank you to you and to Aviva for your time this afternoon. I really, really appreciate it. Those slides are really impressive and highly informative. We'll send these out to you. Thank you to all of you for attending and for taking the time out this afternoon. And we look forward to seeing you soon. Take care and thank you.
Thank you.